for a second straight day. We're below $65 a barrel after the ceasefire, quote unquote, in the Iran-Israel conflict. As I mentioned, it's down about 14% the past 2 days. Does that make the sector more or less attractive to long-term investors? Here with his thoughts is Kevin Book. He's managing director of research at Clearview Energy Partners. Kevin, it's good to see you, and you can kind of start where you'd like, but anytime in the past few days we've seen oil behave more positively, people go, maybe it's a chance to jump in. The energy sector is so shriveled as a portion of the S&P and all of that. Then you get price action like the last couple of days, and maybe you think, never mind.
Yeah, Kelly, good to see you. What we saw was a geopolitical risk premium. It's something that people said had either gone extinct or was an endangered species. The market responding to what looked like a visible horizon of supply shock. And the movement we got was actually quite significant when you consider that where we were was with 3 successive months of supersized OPEC supply additions on top of demand weakness and expectations for economic reversals later in the year. That was a lot of movement. But at the first sign that barrels could not be at risk, and actually then this morning finding out that maybe more, 600,000 or more barrels per day of Iranian crude could come back, the selling continued.
Right. So you can be as specific as you want, when it comes to investment wise, what you think people should or shouldn't do here. And also what the implication, a lot of people say, look, the fact that we are such a big producer is what cushions us from some of the tension. Even the Strait of Hormuz, like a lot of that oil is going to Asia, as we've talked about. So just kind of give us your sense, both from a national point of view and also an investment point of view, what you think people should do here.
Well, we don't make investment advice at Clearview, but I will say that what we see are fundamentals still driving the end result, the outcomes. Now, there's a lot of different aspects to that, and the geopolitical influences also include pressure to the downside from trade risk. We're 15 days out from possibly the resumption of reciprocal tariffs. We have one deal to date with the UK, and of course, Trump going to NATO, we don't know what we're going to get from that. It may be harmony, but it may be disharmony. And a resumption of that downside risk from trade. So where are we looking in the long run? The costs are still rising to the extent that tariffs contribute to higher costs for producers. Demand is still weakening. So there's real concern on the horizon.
Right. But sort of if the costs are rising and demand is weakening, then you think we're heading significantly lower on the oil price?
Well, not necessarily that we're going to see lower, because if you see less production response to market catalysts and factor cost inflation, you might actually see more balance. But where we are right now is with OPEC still adding back to the market at a time when it's looking pretty long. 1.5 million, 2 million barrels per day this year and next, supply ahead of demand, if you sort of ballpark the projections. So that I think is cause for reflection.